Alex Martin is a principal and transfer pricing practice leader here at KBKG. He has 25 years of full-time transfer pricing experience working in Washington, D.C., Melbourne, Australia, and Detroit, Michigan over the course of his career. He has assisted companies in many industries addressing transfer pricing issues on a U.S. and global basis. As a result of Alex's expertise, KBKG was recently named one of the world's leading transfer pricing consultancies for the second year in a row by International Tax Review. And with that, I'd like to turn the presentation over to our speaker.
Thank you, Caesar, and welcome everyone from around the world. Let's get this moving here. The idea here is that we're going to talk through transfer pricing issues. So at the end of this, you'll have a good handle on how to identify, assess, and discuss transfer pricing from a high level. Now, we're going to do that in a couple ways. We're going to talk about how to identify transfer pricing red flags from an IRS and other global perspective. We're going to be talking about a couple court cases and news articles that may be of interest. But we're not just going to talk about compliance. We're also going to go through some transfer pricing tax savings that may be certainly overlooked and may be particularly relevant now that we're towards the end of 2023 at this point of the recording. We'll also talk about how the Inflation Reduction Act and some global transfer pricing developments might help you or might affect you or the company. So one last thing, I will be going through 10 transfer pricing takeaways just to help provide some good reminders of how transfer pricing works and some good strategies that we found would be useful. Let me jump right into an example of why transfer pricing is important. Let's take a German manufacturing company that is selling auto parts into the US. If the German company charges too high a price for auto parts, the IRS is unhappy. Why? Well, that US distribution subsidiary is not paying its fair share of tax. Conversely, if that German manufacturer parent charges too low a price, the German tax authority is unhappy. Why? Well, they are not getting their fair share of profit at the end of the day. So this is one tax issue where two tax authorities can look at related cross-border transactions and judge whether those transfer prices are correct. We'll talk about how to get to that point shortly. And while I'm covering auto parts in this example, it really doesn't matter. It could be goods, royalties, service charges, loans. As long as it's a transaction within the same related company, there's a transfer pricing issue in play. That's going to affect how much tax you pay in each country, affect how much tax you pay on an overall basis, and believe it or not, it also affects cash flow by country. Let's go a little deeper here. Let's talk about a real life example. Starbucks, as everybody has visited on multiple times, is a worldwide multinational company. In this case, Starbucks purchases coffee beans off of an exchange in Switzerland. They sell coffee beans to Starbucks in the Netherlands that does roasting of the beans. Starbucks in the Netherlands ships coffee beans to the UK where they're sold in retail shops. In addition, Starbucks UK pays a royalty for use of the intellectual property, the trademarks, the store layout, the recipes for making different coffees. So really comes down, transfer pricing is all about making sure companies pay the correct amount of tax in each country where they operate. So the question here is, where should profits be generated? Well, bit of a trick question here. One place profits weren't generated was in the UK. And in fact, activists took over Starbucks outlets all across the UK. Why? Well, Starbucks had only been paying tax once out of the previous 12 years. Now, the company said that the reason we're not paying tax here is that we didn't do a good job in negotiating rents in central London. A lot of other people said, well, hold on a minute, you're paying royalties to the US and you're paying lots of money to the Netherlands. We think you're being overcharged for these transactions, and therefore we don't think you're paying your fair share. So obviously there's a reputational risk at play here too. And I'm not really aware of another tax issue at the corporate level than that really drives as much passion as transfer pricing. Want to draw an insight here. Tax auditors often argue that subsidiary companies should not incur losses. And that's important because if you're trying to figure out if you have a subsidiary, if you're trying to figure out if there's a transfer pricing problem and you see a subsidiary company that's incurring losses, you can bet that a tax auditor is going to have heartburn over how much tax they pay here or not pay. And in fact, Starbucks managing director was actually called before Parliament to explain why they were avoiding tax. All right. So could this happen in the US? Well, actually, short answer is yes. And this is a very recent development. The IRS does not want foreign-owned distribution companies incurring losses or minimal profits. And actually, the IRS just announced, I want to say in the last month, that they'd be sending 150 compliance alerts to foreign-owned distribution companies. Why? They want companies paying minimal profits or incurring losses to self-correct their transfer pricing. It's kind of a shot across the bow. And we anticipate that the IRS will continue to target foreign-owned distributors because they've got a lot more, they have a lot more resources to hire auditors as part of the Inflation Reduction Act. And to be frank, having auditors often argue that the parent company should incur losses rather than subsidiaries. So even though you'd like to say, you can try to argue that the reason our distributor is losing money is because of business conditions, most tax auditors are going to say that's a parent company problem and you should have lowered the transfer prices to the subsidiary. We've got an article on that on our website if you'd be interested in reading more. All right, so let's talk about the other side of things. If you may have heard, may or may not have heard, that the IRS has been fighting Coca-Cola for a very long time over transfer pricing as well. And Coca-Cola, as you might expect, licensed its trademark, product names, patents, formulas to subsidiaries all over the world. The IRS came in and said, we think you're shifting profits offshore to several countries. They said they were undercharging Brazil, Costa Rica, Egypt, Ireland, Mexico, Swaziland. Basically, we think since you've been undercharging, we are going to increase the taxable income on the US side. And in this case, the IRS has issued over $9 billion in transfer pricing adjustments, and that's what was argued over in tax court. Well, and taxes due were over $3.2 billion. Now, Coca-Cola is still fighting the IRS, and in fact, Coca-Cola lost another case regarding a Brazilian subsidiary for another $500 million just the other day. What's the insight here? Tax auditors, including the IRS, or frankly, any country that has a parent company in it, they don't want to see subsidiary companies earning too much profit. So we've got the balance here. Are you paying too little of profit by the subsidiaries or too much? All right, so what companies have transfer pricing issues? Well, really, every US company with international operations, every international company with US or global operations, and again, goods, royalties, services, loans, they all affect how much tax you pay. Now, fortunately, the rules, transfer pricing global rules are broadly similar worldwide. So the US has in section 482 has what references the arm's length standard. And the OECD, if you haven't heard of that before, Organization for Economic Cooperation and Development, kind of like the UN, except more focused on economic issues, they also have transfer pricing guidelines, which are the global standard. Now, I worked overseas for 4 years, so everything we talk about here in terms of strategies and thought processes, they really do apply on a worldwide basis. Now, when I started years ago, there were probably 13, 14 countries that enforce transfer pricing. That is now well over 100 countries now. And as you'll see, why? Well, it's a very high return on investment. So how do companies manage transfer pricing? Well, perhaps there might be a bit of a surprise here. Let's take the example of a pharmaceutical company parent that's come up with a cure for the common cold, and they have a subsidiary in France that is manufacturing those drugs for the EU market. Well, what's a transfer pricing issue in play? Well, the US is selling a proprietary ingredient that goes into manufacturing these pills. France also pays a royalty for the intellectual property utilized for producing these products for the European market. So a couple questions come to mind whenever you're talking about transfer pricing with a client for the first time. You may ask, well, how did you set transfer pricing in the first place? And quite often you'll hear some hemming and hawing, but where they say, well, we've got a cost plus 10% policy. And that may have worked really well for years. However, that cost plus 10 policy may not be the same or may not give you the same results when we've had all the business changes from COVID, from supply chain restructurings, from product changes. So maybe the cost plus 10 policy is correct, maybe not. Tax authorities are more focused on the results of those transfer pricing policies as opposed to whether the policy itself is correct. Second thing that comes up is that a company operates as a borderless business, which makes a lot of sense from an operational point of view. I'm trying to manufacture this product for as low a product price as possible, and I'm trying to sell at as high a price as possible on the European side. You ask the question, well, how do you set transfer pricing for this company? Well, they don't care. From their perspective, it's all part of the same pot. They're just trying to maximize the overall profit. Problem is that you've got a different thought process or a different perspective if you're the IRS or the French tax authority. Why? Well, if I'm a French tax auditor, I don't know much about this business, but I do know how much tax they're paying. Same thing on the IRS side. Again, I may understand what the overall profit is, but I'm focused on that borderline, that border, because that transfer price affects how much profit is generated by country. And third, and this might be most surprising of all, is that sometimes you'll ask the question, well, we do ask the question, hey, does anybody's compensation depend on the transfer price? And what do I mean by that? Let's say the pharmaceutical plant manager figures out that if they charge $1 million more to the French subsidiary, well, they get a bigger bonus. They increase their compensation. So while that's great from the plant manager's perspective, and certainly the IRS is happy about that because there's more profit in the US, there's less profit on the French side, and in fact, that counterproductive game playing actually leads to an exposure on the French side. What's the insight here? Really, transfer pricing exposures may have absolutely nothing to do with tax strategies. Certainly, a lot of companies, some of the larger companies do have very aggressive or sophisticated tax strategies, but for a lot of companies, it's not something they address very often, and so therefore there may be some issues there that might be a bit of a surprise. But let's take the example of that company that's come up with a cost plus 10% policy, and what happens if the IRS comes in and audit and disagrees? Well, this gets pretty expensive pretty quickly. So let's assume a transfer pricing adjustment of $10 million. Well, from an IRS perspective and the US company perspective, they'd pay 21% on that $10 million increase in taxable income. And then they have what are called transfer pricing non-deductible penalties of 20%. So that's $420,000 of cash out the door. So what do you have here? $2.52 million plus interest, plus US state tax. And just because the IRS has made a transfer pricing adjustment doesn't mean the French side is going to give the money back. So effectively, you have a double tax situation. So we're not arguing over meals and entertainment expenses or depreciation schedules, what have you. The IRS is just coming to the table and say, we think you're overcompensating your French subsidiary, and since you've been shifting profits offshore, here's how much money you're going to owe us. Now that 20% penalty starts at a $5 million transfer pricing adjustment. Sometimes it's a 50% adjustment to cost of goods sold. Those penalties increase to 40% at $20 million. All right, so what can you do about this? Well, if you've come across transfer pricing before, you might have heard of what's called transfer pricing documentation. Effectively, it's your first and best line of defense to avoid an audit in the first place. What does it mean? Well, there's in the 62 transfer pricing documentation rules, they list 10 items. But really what it comes down to is tell me about how the business operates in the US and overseas. Tell me about your industry and where you fit within it. Tell me about the financial transactions and most likely the profits of the client, both in the US and overseas. And then here's where the tricky part is. The economic analysis demonstrates why transfer pricing is arm's length or correct. And quite often that utilizes what are called comparable databases, where you're benchmarking the profit margin of the subsidiary to publicly available companies that do similar or have similar activities. Now, what's a best practice? This report, which is effectively a 30,000 foot view, 10,000 meter perspective on how the value chain of the business operates. And you want to have that report explain transfer pricing on both sides of the border. And while we're talking about US transfer pricing documentation rules, it's actually most countries around the world have very similar documentation standards. So what's the insight here? These reports can be 50 to 100 pages. But if you're reading it for the first time and it doesn't make sense to you, it's not going to make sense to a tax auditor. It needs to be a clear explanation of how the business operates, and it needs to have a nice, clean explanation of why the transfer pricing is correct, not just for the US, but on both sides of the border. So what's that used for? Well, I'm sorry, let me step back. What is actually, let's go into a little detail on what it includes. Well, transfer pricing reports are effectively a narrative of how the company operates. So for example, we're a big fan of presenting or asking questions, open-ended questions about, for example, the R&D. Which country developed the product or service and how? What kind of cross-border R&D services are provided? Who's responsible for them? Who bears the risk of research and development failure? And what kind of process intellectual property is utilized by related parties? All of these things are very important. And as an aside, the reason I've been doing this for 25 plus years is that you get to meet very interesting people and learn how they operate. A lot of times they'll tell you they're God's gift to the company. So it's pretty interesting to see how that all works. And while that's the R&D side, you're gonna have similar interviews with sales, marketing, finance on both sides of the border. What's particularly relevant now? Well, what kind of business circumstances have affected profitability? For example, COVID. Which company did bear the risk of those losses from COVID shutdowns? Which ones hasn't? But you got to remember your audience here. You want them to, the tax auditor reading the report wherever they are in the world, to understand how things are, why the transfer pricing is correct, because you've got the first and best opportunity to review explain how your business operates. It won't necessarily be your local tax auditor. Your transfer pricing report may be shipped to an economist in Washington, D.C. to have a first look. Well, what happens if you do a study? It's prepared on a timely basis. Well, contemporaneous documentation, it doesn't guarantee that the IRS is going to agree with you. However, it does prevent penalties from being assigned. So effectively, this is what's called contemporaneous penalty protection documentation. Same example as we presented before, $10 million adjustment. You still owe the $2.1 million in tax and interest, state tax, and double tax. That being said, when does this report have to be prepared? Well, it needs to be prepared, a draft of the report needs to be prepared by the tax return filing date to be considered penalty protection. So in other words, and this is the case in most countries, they want to have a draft report in place, again, by that tax return filing date. Now, in the US, you do not hand over the transfer pricing report with your tax return. You hold it on file until the IRS requests that under audit. Now, one question I find that's quite often a misunderstanding here is that, do you have to do a transfer pricing report every year? Well, the short answer is yes, to be considered penalty protection. That being said, once you prepare a report for the first time, again, that 50 to 100 page document, you can update the financials and economic benchmarking as long as most issues have been resolved or haven't changed all that much. So you do a report for the 2023 year, and then you update it for 2024, 2025, referencing the original report. Why is this the case? Well, these transfer pricing reports are designed to support the answers you disclose on a tax return. I've highlighted this one in yellow because it's misunderstood by many people. Transfer pricing reports need to be updated annually to be considered contemporaneous penalty protection documentation. Now, the IRS has come out with a lot of insights over the years or their observations. Look, the IRS does not want to waste time auditing companies that are complying with the transfer pricing rules. So they want a clear explanation, again, of how the business works and why the transfer pricing is correct. Now, what does that mean from a practical perspective? You want the IRS to look at a report, get bored, and leave. And they don't want to see just checklist of who does what and when. They want to understand how the company operates and what business conditions have affected things over time. One other misunderstanding I hear from time to time is that check the box entities transfer pricing is not applicable to check the box entities. That's actually not the case. The IRS does apply transfer pricing principles to disallow foreign tax credits if you're overpaying tax to international tax authorities. So again, that's another misunderstanding. There is a chief counsel memorandum that may be helpful here. The IRS, but inside here, the IRS is much more likely to accept your position if the company has prepared transfer pricing documentation. Why? Ready to go. Here's our story. No need to move any further. All right. So what do you look for? Well, I'm a big fan of looking over readily available information. What I mean by that is income statements segmented on a country by country basis. So US, France, China, Mexico, Australia, what have you. That gives you a handle on where profits are ending up within the organization. The US tax return, why that explains the volume of intercompany transactions flowing between countries. And then I also like to review any existing US or international transfer pricing documents. Even if it's not current, that's going to give you a good handle, a good starting point for understanding how the business operates. So that's going to, by taking that kind of information, you're going to be able to prioritize the largest transactions, the highest risk, and as you'll see, some opportunities. For those companies that are very large, you might hear about the master file or local files, but those are for companies that over $850 million in revenue. What is it? We have a list, if you might be interested in an information request list that you're welcome to share. You can request a copy of this form after answering the final CPE question. Well, but what happens if the IRS comes in and says, hey, great, we like your transfer pricing, nothing to see here. Well, what if you've been overpaying tax in the US? Well, that actually may be causing heartburn from a foreign perspective. If a Canadian tax authority audits your transfer pricing, what if they see that you've been overpaying tax in the US? They're going to come to the conclusion that, hey, if the US has been overpaid, we have been underpaid. So effectively, a report that doesn't cover both sides of the border actually could be creating an exposure or a roadmap for a transfer pricing audit. So I get a little concerned when I hear, hey, our Canadian auditor said they did a report. Great, what does it say from both sides of the border? Or our Mexican company is required to do transfer pricing documentation. Great, does it say that Mexico is earning too much profit by comparison to the US? And again, most countries have similar documentation standards, so should be able to at least compare what one country is saying to what you may be trying to say. All right, so now, are you required to do transfer pricing documentation? Answer is no. In the US, you are not required to do transfer pricing documentation. That being said, it's certainly a best practice, but for some companies, they don't necessarily need to do the full report. And so one of the things we talk about quite regularly is for those companies that do not have a large volume of intercompany transactions, perhaps they're just starting out, perhaps they're just trying to get a handle on what the transfer pricing should be, is what we call a transfer pricing benchmarking study. And so while it's not penalty protection, it provides a nice 30,000 foot view, 10,000 meter view where you're benchmarking profit margins for the subsidiary company. In this example, these are 8 companies you probably never heard of, but they distribute industrial products. Well, let's say for some of our companies, we'll do this type of analysis, try to find public companies with financial data so we can target, in this case, a profit margin between 5% and 8.2%. And what benchmark or what profit level indicator do we use? Earnings before interest and tax as a percentage of net sales. Why? That's relatively easy to calculate from a company perspective. And quite often that's the type of benchmarking number that's used in transfer pricing reports. Now, I don't go through all of the methods here, but this at least gives you a handle on how a lot of companies benchmark their transfer pricing when they may not be, it's still early days for them. Now we're going to be jumping away from the compliance side of things to what might be surprising, which is transfer pricing tax savings. So what do I mean by that? Well, we know now that transfer pricing impacts where profits and losses accrue by country. And one thing that we found a lot is that with all of the changes in supply chains, COVID, not necessarily having a good handle on transfer pricing, well, we're actually finding that a lot of companies have tax net operating losses in one country and big profits in another. So why do I bring that up? Well, we've seen how net operating losses can be problematic from a tax audit perspective, but actually it may be a great opportunity for using transfer pricing to save a lot of money. So let's take another example. Same German company selling auto parts to a US subsidiary. So let's say, for example, they average $70 million in US revenue, US company revenue, but they had a market downturn and revenues are down to 65 million. Well, due to this downturn in the business, they're incurring losses. And for sake of this example, let's just say the parent company is earning $6 million in profit, paying a 30% rate, so about $1.8 million in tax. Now, if I'm an IRS auditor, am I happy about seeing a company, US company subsidiary, incurring a loss when it's owned by a foreign parent? Frankly, I'm having some heartburn here. And sorry, as an aside, great question here. We're actually focused on book income rather than tax income. So we're not looking at what your profit is after accelerated depreciation and things like that. This is book income from your annual reports income statements. So again, looking at the earnings before interest and tax. So IRS is having some heartburn here, but what can you do about it? Well, the IRS is thinking, well, would an independent distributor continue to purchase products and incur losses from an independent party? Their thought process is, well, no, pretty much not. You would renegotiate that contract. And you might say, well, it was a foreign exchange issue. Realistically, their starting point is going to be that's something that the parent company should bear. The parent company is in a better position to bear. So therefore, the US company should effectively be insulated from that. So what would happen if we reduced the transfer pricing by $2.5 million? Well, that gets you to break even in the US. And while the IRS certainly would want to see more than that, in this example, we're moving our German parent company income from $6 million to $3.5 million. So the savings would be a $2.5 million adjustment times 30%. That's $750,000 in cash savings, and you're reducing the tax audit risk from an IRS side. Great question I've got here. What does the German tax auditor say? Well, yes, they may have some concerns about the changes in the transfer pricing, but I would turn that argument around. I would argue that, if anything, the German tax authority has been overpaid in previous years because the US company wasn't getting its fair share of profit. So again, balancing those types of things are important, and you should have substance behind explaining that change, but it's there. It's something that is much easier to address. For example, between now and December 31st, if you're a calendar year company, because that'll reduce your audit risk, plus, again, maybe identify some significant tax savings. Let's take another example. Let's say we've got a company that's using a cost plus 10% policy on manufacturing in China, for example, and they're charging $10 million to a parent that's incurring loss. All right, well, what would happen if that manufacturing subsidiary reduced their transfer pricing by $2 million? Well, that still gets the parent company to break even. Probably would want something more than that, but for purposes of this example, $2 million times a 30% tax rate is $600,000 in tax. Again, big savings, and given the COVID, given all the changes in the supply chain, those types of savings might be out there. You just kind of have to look for them. And again, using those off-the-shelf financials is really going to make a big difference. There are a couple of tax court and global developments that I think are also going to be, over the long run, important. And I'm going to come back to Coca-Cola. And I probably didn't reference this before, but the tax court was covering 2007 to 2009. That was not a misprint, and the first tax court decision came out in 2020. So these are, once these audits start, they do take quite a long time. Well, Coca-Cola said had reached agreement on a transfer pricing audit back in 1996. They came up with a bit of a formula to apportion profits on a country by country basis. Now, Coca-Cola, after this audit started in 2007 and 2009, really was having some use the exact same formula from this closing agreement on a go-forward basis. Well, the IRS said, well, the IRS hadn't audited over a decade, so therefore the transfer pricing must be acceptable. And the IRS responded that the 1996 closing agreement had nothing to do with go-forward transfer pricing. So, and the tax court judge agreed. They've made a couple other arguments that, frankly, the judges called futile. That even if while the transfer pricing agreement was in place and they haven't been audited, the IRS all had the opportunity or had the power to make adjustments post after the original closing agreement. So really a lot of the tax court questions came down to, well, should a low risk contract supplier earn large profits? And does this 1996 IRS settlement make a difference when we're auditing transfer prices? And then, hey, just because you haven't been audited before, does that mean your transfer pricing acceptable? Well, the judge completely dismissed all of these arguments, and let's take a look at what the judge was saying. Well, going from left to right, the average food company has a 10% return on assets over 2007 to 2009. Coke globally has a 53% return on assets. And then the judge is seeing Coke Mexico with a 94% return on assets, Costa Rica 143, Brazil 180, and Coke Ireland to 214%. And the judge is saying, the IRS has said, these profit margins for these companies are far in excess of what a reasonable level of profit should be when all, if most, if not all of the intellectual property, the Coke brand name, the Coke formula, all of that kind of good stuff is owned in Atlanta, Georgia. So that's why the IRS won this case. And effectively, even a 9 billion transfer pricing adjustment is 9 billion transfer pricing adjustments, a big invoice. Now, what does this mean for us day to day? Well, again, U.S. companies with highly profitable subsidiaries face more risk now. They can apply this Coca-Cola transfer pricing tech court case as a template for auditing other companies. So effectively, U.S. companies with profitable subsidiaries have faced risk. Companies should not rely on a lack of audit activity as assurance that transfer pricing is correct. And in fact, Coca-Cola lost another appeal in October 2021, where the judge called out the futility of the positions Coca-Cola seeks to advance. Now, Coca-Cola still believes they're going to win on appeal or at some stage, saying that they've reserved $400 million up through 2022. Why do I say this up to 2022? Well, Coca-Cola has been using the exact same formula up through 2022. They say that if the IRS continues to win, Coca-Cola will owe $14 billion in tax. That's a lot of money, even for Coca-Cola. So what's the insight here? The Coca-Cola court case is a template for large tax adjustments, again, focused on that big transfer pricing adjustment here. All right, so what's the takeaway from here? Well, look, you want to review annual book profit margins of each subsidiary when trying to get your arms around the risk here. If you've got subsidiaries with losses or tax NOLs, there's a subsidiary tax risk. That's the Starbucks situation. If you've got large profits in the subsidiaries, you have a parent company tax risk. That's a Coca-Cola situation. And I neglected to mention that actually some states, separate entity states, also have transfer pricing rules on the books. New Jersey actually hired an outside economist to do some audits. North Carolina, Indiana have similar programs. And touch on this briefly, but a lot of companies have very low thresholds for transfer pricing documentation and very high expectations of profits. India, for example, has a safe harbor rate of cost plus 20% for IT services, for example. So in other words, they're saying that if you set up in India, we do expect higher profit margins than what you might see elsewhere. All right, so there are some new developments You may have heard of the Pillar 1, Pillar 2, and basically it's trying to get their arms around the largest companies and making sure they pay a certain level of profit. And what do I mean by that? Well, they want to make the Amazons of the world that have revenues greater than $20 billion and high profits are going to pay taxes in every country where they operate or sell. Goal 2, for the companies, the largest companies would pay at least a 15% income tax in every country where they operate. Well, as of now, while European countries and a lot of Asian countries have decided they're going to go ahead with this, the U.S. House of Representatives have certainly made it clear that they don't want, they're unlikely to pass this. And basically the GILTI tax, if you may be familiar with U.S. tax law, is more the way to prevent multinationals from paying tax. I'm sorry, prevent them from avoiding tax. Now, even if that's in play, does a global minimum tax resolve transfer pricing issues? Well, it's, in my perspective, a nice backstop, but governments will still generate a lot more income from transfer pricing audits. For example, the IRS would argue that yes, Ireland might pay a 12.5% tax rate. The IRS would get a little more profit, but it still makes a lot more sense for a tax auditor to make an adjustment for 21% plus penalties. So really the insight here, again, audits are a high return on investment, even with a global minimum tax. So here are my takeaways. We've talked about them already. Tax auditors shouldn't argue that subsidiary companies should not incur losses. That's Starbucks. 2, tax auditors argue that subsidiary companies should not earn excessive profit margins. Coca-Cola. We've talked about arm's length standards apply in over 100 countries. Transfer pricing exposures may have nothing to do with tax strategies. And again, if you do come across that transfer pricing report, and I would request that if you're working with a client that has multinational operations, it might not make sense. Reports need to be updated annually to be contemporaneous. The IRS is much more likely to accept your position if you have a transfer pricing report ready to roll. And don't forget, number 8, don't forget about that tax savings opportunity. We do have some articles on our website if you'd like to learn more details on how companies can use transfer pricing to save a lot of money. Keep an eye out for the Coca-Cola case. All the analysts that cover in Coca-Cola haven't really adjusted for that, so it could be a big news item at some point. And again, transfer pricing audits are still a high return on investment, even if we do have a global minimum tax that comes through. Here are my contact details. Again, you're more than welcome to scan for a meeting or book a meeting or check out LinkedIn. We do have lots of materials, resources available for you if you may be interested. But with that, thank you so much for joining. I appreciate everybody spending their afternoon or, well, wherever you are today. And we look forward to hearing from you in the future.